Okay, we're going to move into our next presentation, and that is withdrawal options from deferred compensation. Our presenter is David Valerga. He's with Voya Institutional Plans, the CalPERS Supplemental 457B plan. David has 18 years of experience in the financial services industry, with over 15 years of experience with governmental 457B deferred comp plans. David holds a Bachelor of Science degree in Business Administration with an emphasis in finance from Cal Poly in Humboldt. He has a Series 7 and Series 6 investment licenses, California insurance license, and is a certified retirement counselor. Thank you very much, David. We appreciate you being here today.
Thank you for having me, and thank you for that introduction, Doris. I'm assuming you can hear me well. I'm hoping the background noise doesn't play in too much here.
I hear you fine. We see you.
Okay, great. Okay, I'll go ahead and share my screen here, and we will talk a little bit about deferred compensation 457 plans. And we'll talk about this at a high level, withdrawal options, and we'll start out with contributions and then how that plays into the withdrawal options. And then at the end, we should have plenty of time for questions, and we could work through those as well. So again, thank you. Here's my contact information. At the end of the presentation, there'll be another slide with there'll be my email address, my phone number. And just to let you know, this afternoon, I will be in conference room B. It's over on Low Gap, the admin building over on Low Gap Road. So if you're interested in meeting with me, you can send me an email, give me a call, or just drop by. So I'll be in that conference room starting at 1 o'clock today, and I'll be there till 5. So please connect with me. I'm happy to talk to you about deferred compensation. Now, with deferred comp and the County of Mendocino, there's two different ways you can contribute. So the first one is, we'll start with the pre-tax option, and really this plays into the distributions that we're going to talk about here in a moment, where with pre-tax contributions, you're contributing pre-tax dollars to your deferred compensation or 457 account. So your current taxable income is reduced by the amount that you're saving at this point. Contributions and earnings grow tax deferred until you start to take withdrawals in the future. And the distributions, they will be taxed as ordinary income when you separate from service. Now, the second option is the Roth contribution option, where you're not limited to pre-tax or Roth. You could actually do both. And with the Roth contribution, you're paying the tax on that contribution going in. So your contribution is not reducing your income at this point. You get tax deferred growth, which means that the contribution and those earnings are growing tax deferred. And to get the true benefit of the Roth, you'll need to reach these 3 milestones here, and I'm just marking them up. You have to separate from service. You need to be age 59 and a half, and you have to have had the account for 5 years. So if you meet all 3 of those, then the distributions become tax-free. If you meet 2 of them, then you're going to be taxed on those gains. You've already paid the tax on the contribution, but the gains would be taxed at that point. So to get the true benefit of the Roth, you'll want to meet all 3 of these specific milestones. The separation from service, at least age 59 and a half, and have had that account for 5 years. Okay, so with distributions from a 457 plan, so on this, the key to a distribution is you have to separate from service. Now, when you separate from service, 2 things are going to change with your deferred compensation account or 457 account. The first is you're not going to contribute any more money because all contributions, they go through payroll. And the second one is you can start taking money out of your account. Now, there's a caveat to this where if you rolled money into your account, and let's say the example would be you rolled money in from a 401k, you would have access to those funds prior to leaving employment with the county. Now, that's true on the CalPERS side. If you contribute to another program, the Empower program, I would encourage you to connect with the representative there and verify that within their program that they would allow you to do that as well. So when you separate from service on the CalPERS side, within the CalPERS program, and it's called My CalPERS, the payroll will go in and they will update your employment status. Once your employment status is updated, this allows you to begin to take withdrawals. Now, you don't have to take withdrawals, but if you want to, you're able to. The benefit of a 457 account is right there. That's a huge benefit where prior to age 59 and a half, if you leave employment with the county, there is no penalty to access the money. And you will pay tax depending on how you contributed the funds, but there's no 10% penalty for a distribution prior to age 59 and a half. So I'll use an example of myself where I have a 401k. If I leave my position, I will pay, and if I leave my position and I take money out of my account, I'm going to get taxed on whatever I take out, but I will pay a 10% penalty until I'm age 59 and a half. So for me, obviously, I don't want to access anything till age 59 and a half. If you work in the if you're in the safety departments like a sheriff and you're able to retire at a younger age, the 457 account's a great way to save money and then have access to it without a penalty prior to 59 and a half, because a lot of times service individuals are able to leave at a younger age. So again, there's no penalty based on your contributions and your gains. If you roll money into the program and it came from a 401k and you try to access that money prior to 59 and a half, you would pay a penalty. So there's a little caveat on that one. Now, distributions are flexible from these programs. Yeah, you have the access to leave the money in the program. You can manage it throughout your retirement. You can take withdrawals as far as lump sum withdrawals, installment payments, that would be a monthly payout, or you can do both. So you have some leverage there. Now, also a third option of distribution would be if you wanted to take your account after you've left employment, if you wanted to take your account and roll it to another account, for instance, a traditional IRA, or if you're going to work somewhere else and you decided, I want to roll this money over to their program and I want to start to contribute to it at that point in time, you're able to do that. So leaving employment's key, but you're able to roll money over. If you have the option to purchase service credit, you can take money from a 457 account and roll it to purchase that service credit. So within the CalPERS program, how do you request a distribution? There's a couple ways to do this. The first one is you can go, if you access the Voya website, and I say Voya because with CalPERS, Voya, who's an insurance company, they administer the CalPERS program. So technically I work for Voya, but everything I do is CalPERS through Northern California. So when you sign up for CalPERS, you have access to your account on a Voya website. On that website, you're able to input your banking information And when you leave employment, your status of employment would be changed from active to separated. And at that point, you could take a distribution directly from the website and do a direct deposit to your bank account, and it's free. So there's that option. There's always the option of completing a form and sending it in. Ways that you can obtain the form would be, or there's forms. So depending on how you want to take a withdrawal, as far as a lump sum or a monthly installment payment. But with the forms, you can go to the CalPERS-SIP.com website. All the forms are on that website. There's additional information there as well, but you can find all the forms there. You could always contact me as the account manager. I'm happy to get those forms to you. And then we have a client service center as well. With the client service center, you can call them, you could request that form, and they will provide that to you. Again, I put rollover and service credit. So when you leave employment, you have access to those. Down at the bottom here, I have loans and hardship withdrawals. So while you're working, you have access to your account in the form of, you could take a loan from the account. And with a loan, what you're doing is you're borrowing from yourself and you're paying yourself back through payroll. So with a loan, I always consider this one of your last options. You're borrowing from your retirement, which is never a great thing. But if you have to do it, it's there for you while you're working. With the loan, you're able to borrow half your account value up to $50,000. With the hardship provision, this one's very specific, where this is an IRS provision, and there's multiple things that the IRS considers a hardship. A lot of times I'll get a phone call from an individual and they're asking for the hardship form, and they're informing me of what their hardship is. But at the end of the day, it's what the IRS considers a hardship, so it might not necessarily be what we would consider a hardship. So keep that in mind. A lot of times that's going to be with medical payments, foreclosure on a home, death of a family member, a beneficiary, natural disasters. So it's really life-changing events that play into the hardship withdrawals. So with distributions, again, it's pretty simple. I mean, as far as you have a lot of flexibility. When you leave employment, you really don't have to do anything with the 457 account, because you could leave it in the account if you wanted to. And the only time that you're required to take a distribution, it's called a required minimum distribution, or an RMD. And with the RMD, at this point in time, they just bump the age up to age 73. So if you happen to be working and you're past the age of 73, you don't have to take the distribution from a 457 account while you're working. But once you leave, you would have to take that distribution. And if you have a CalPERS account, and this would probably be true of Empower as well, but you'd want to check with them again. If you have the account, we would notify you and let you know that in this calendar year, the dollar amount that you will be required to remove from your account would be X amount. So you would be notified of what that amount is, and you would need to take that withdrawal prior to the end of the calendar year. So here's my email address again, my phone number. There's a QR reader here where on your phone, if you're a tech savvy individual, you could pull up the QR reader on your phone. This will take you to what is called our Time Tap website at CalPERS. And from there, you can request a phone appointment with myself or any of the other account managers. And there's about 6 to 7 of us throughout the state that services different territories. So feel free to schedule a phone appointment that way, you could always email me, give me a call, and I'm happy to schedule a time to speak with you. Again, I will be in conference room B at the admin building over on Low Gap Road this afternoon, yes, from 1 to 5. And I'm happy to schedule a time to speak with you and talk about the program. And with that, let's, I see that there's some questions that somebody has typed in, or a couple people have, so I'm happy to answer these. The first one is, so I have money in an old deferred comp account and would like to switch. How do I transfer my money over? This is a great question. Step one is that you would want to have in place an account, whether it's CalPERS or Empower. You'd want to have the account open, and then you're able to roll the money into the account from there. On the CalPERS side, we offer a program to help you roll the money in. So yeah, I would suggest contacting me directly. We can talk about the rollover process in a little more detail, and really how that process plays out, to help streamline how that works and make sure that we're crossing the T's and dotting the I's correctly. We want to do it right the first time. Okay, so I only have 22 months to go to retirement. Is it worth doing one of these deferred compensation plans for a short period of time? I hear this question a lot, and there's a couple ways that I answer it. In that, it's if you're going to put in a large amount of money, yes, it's a great way to save a large chunk of money in a short period of time. So in a calendar year, the dollar amount that you're able to save, if you're under the age of 50, it's $22,500 this year. If you're over the age of 50, it goes to 30,000. So you can put a lot of money into these. Also, another thing to think about is if you have benefit time, like vacation time, that you're going to get paid out on, if you want to defer that into deferred comp, the 457 program, you are able to do that. And by doing that, you might be saving on taxes, where the payout of that benefit time might get taxed at a higher rate, where if you put it into deferred comp, in the future, you took it out, you're going to get taxed at your normal income rate at that point in time. So you have a little more leverage on how you want to pull the money out of the account. So, to backtrack and talk about this question, it really comes down to how much money you want to put in. I always say that if you're able to save a little bit, yeah, depending on how you want to use it in retirement, it's never a bad idea. So the following question, is it only CalPERS that could be used to purchase service credit or another party's 457? So with this with this question of purchasing service credit, you're able to transfer funds or roll funds over from a pre-tax account to purchase service credit. So whether it's CalPERS, Empower, if you had a nationwide account still, you were able to do that. VALIC, they had a program here as well. You could use those funds to purchase service credit. So it's not just the CalPERS program. And then finally, the last question, is there any penalty for a rollover? The answer to that one's no, because you're rolling over pre-tax dollars from another account. And this is a good question, where the easy answer is no, there's no penalty to roll money over, because it's all coming from qualified accounts into a 457, which is considered a qualified account. The only type of account that you would not be able to roll into one of these 457 accounts would be a Roth IRA. And with the Roth IRA, the distribution rules are a little bit different. So that would preclude your ability to roll that into a 457 account. But if you had a 401k, another 457, 403b, all of these different tax codes, and that's what we're talking about is tax codes. All of those tax codes can be rolled into a 457 account. Okay, so with that, if there's not any more questions, Doris, I see you have your hand raised.
Yeah, I just wanted to make a comment regarding the person who had only about 2 more years to work before they might retire. And you mentioned that they could contribute during those 2 years and then also out of their vacation pay. One of the additional advantages that might make it attractive is they're not required to take that money out now until what you said, age 73. So it could stay invested for a number of years. It might be 5+ years before they actually have to take that money out. And that's an opportunity to allow those funds to grow based on what they invested in.
Yes, that's a great point, because you're not only talking about the tax benefit, but you're also talking about the growth aspect as well.
Okay, I'm not seeing any additional questions at this time. Really appreciate you presenting here today. That was a lot of useful information about people who have deferred comp accounts and how they can structure withdrawals out of it. And let me ask one more question. When it comes to taking money out of deferred comp, would I be able to set up monthly payments, annual payments? What type of flexibility do I have with reoccurring schedules?
Yeah, so that's a good question. As far as the flexibility, you could set up quarterly payments, semi-annual payments, or annual payments. And that's one avenue that you could take. On top of that, if you chose one of those and you were looking to do a withdrawal of a lump sum amount, you could do that in addition to it. So it gives you a lot of flexibility on how to take money out.
So I'm not locked into one. I could do monthly payments, and if I needed it, I could do a lump sum to cover an emergency or something.
Correct.
Great. Appreciate you being here today. And again, he's over in conference room B this afternoon if you want to meet with him. Thanks, David.
Thank you, Doris. Have a great day, everyone.